You know that feeling, right? Maybe a friend owes you a few bucks and you're just sort of waiting, hoping they remember. Or if you run a business, it's that stack of outstanding invoices, just waiting for the cash to actually hit your account.
Yeah, that lingering sense of money owed. It can be a persistent, low-grade headache, for sure.
So today, we're cutting through that noise. We're diving deep into a topic that's absolutely critical for, well, every business, big or small, but it often operates behind the scenes. Accounts receivable management.
Right.
It's essentially how companies handle the money customers owe them. Our mission here with this deep dive is to give you a real shortcut. We want to distill the core strategies, maybe some surprising facts, and crucial insights from our sources about managing credit, making sure payments come in on time, and, speeding up that cash flow.
And I'm here to help connect those dots, turn the sort of practical steps into a more strategic understanding. So you see not just what companies do, but why it matters so much to their bottom line, their long-term health. It's all about optimizing that delicate balance.
Okay, perfect. So let's start right at the beginning, the very first hurdle. Before a company even thinks about selling on credit, what's the absolute foundational step, the one they have to take to avoid the pain of bad debts later on?
It really all starts with assessment, thoroughly assessing if a potential customer is creditworthy. This initial check is just vital for trying to head off problems before they start.
Makes sense.
But here's the really critical insight our sources stress. It's not a one-and-done deal. Continuous checks are absolutely vital, especially, for your most valuable customers. It's about getting those early warnings if some kind of financial instability might be creeping in.
Right. So it's constant vigilance, not just a single snapshot in time.
Exactly. Think of it that way.
Okay, so a dynamic process. What are the actual methods then? How do companies peel back the layers and figure this creditworthiness out? First up, there's the bank reference. You can get this pretty easily, apparently. But here's the catch, right? Bank references are often the least reliable for, true risk assessment.
That's often the case, yeah. Banks are primarily focused on their client relationship, so they're highly unlikely to volunteer any fears they might have about their own customer. They'll just stick to the bare facts. Very cautious.
Okay. Then there's a trade reference. This comes from another company that's already dealt with the potential customer.
Right, someone in the same boat.
Yeah.
Yeah.
Getting a formal written one can be tricky, though, because everyone's worried about getting sued.
That's a real factor these days, yes. Our sources really highlight the value of informal oral references. A quick, discreet call to trusted contacts in the trade. That can often yield much more honest, valuable insights than a formal letter ever would.
Interesting. Okay. We also have credit rating and reference agencies. These are the pros, right?
The specialists. Their whole business is providing this kind of information, so they have a really strong incentive to give you the most accurate, up-to-date picture possible.
Because they want repeat business.
Exactly. Their reputation depends on it.
Next, financial statements.
Yeah.
Publicly available, quick to get. Sounds good.
Yeah, they offer a snapshot of past health. But the key insight here is they're backward-looking. They can be out of date or, even worse, sometimes they can be manipulated.
Okay.
For larger companies, though, you can often find analyses of their accounting info online, which can help you interpret the raw data a bit more.
Right. And don't forget information from the financial media. Seems obvious, but maybe overlooked.
Definitely. The national, the local press, industry trade journals, the internet, these can offer crucial forward-looking insights.
Like what?
Well, like reports of a company losing a major contract or maybe key directors suddenly leaving. Those can be signals of potential trouble long before it hits the balance sheet.
Okay, the early warning signs again. And finally, a personal visit. This one feels a bit old school, not very scientific.
It's definitely not scientific, no, but it can make a strong impression on the customer. And maybe more importantly, it gives you a chance to, as one source puts it, get a feel for whether or not the business is one which you are happy to give credit to.
Right.
The source even says anyone who runs their own successful business is likely to know what a good business looks, feels, and smells like. It's that gut feeling.
That intangible sense you get on the ground. I like that.
Yeah.
So looking at all these methods, what really stands out to you?
Well, what's striking is the blend, isn't it? It's hard data, yes, but also these softer, more intuitive insights. It's not just number crunching. It's about piecing together a holistic picture from multiple angles.
Yeah.
And that point about continuous monitoring, even for existing customers, it really hammers home that creditworthiness isn't static. It's fluid. It demands that vigilance, that adaptability you mentioned.
It really does sound like a blend of art and science. So, okay, let's say a company feels confident enough, they've done their homework, they decide to grant credit. What's the next crucial step? How do they formalize things and set the rules for payment?
Okay, the next critical phase is explicitly detailing the credit terms to the customer. No ambiguity.
Right.
This covers everything, the normal credit period, is it 30 days, 60 days, any discounts offered if they pay promptly, and importantly, any interest charged on late payments. Companies often adopt terms that are common in their specific trade, but there's flexibility. Terms can vary based on an individual customer's credit rating, the relationship. It's about managing expectations right from the start.
And a key part of that is setting a credit limit, I assume.
Absolutely. And our sources suggest this limit should only grow slowly, sort of in step with your growing faith and trust in how that customer pays.
Okay, build trust gradually.
Precisely. And any attempted breaches of that limit, they should be flagged and reported immediately, no exceptions.
And you mentioned a watch out here, a common trick.
Yeah, something to be aware of with less ethical companies. They might make a small initial order, pay really promptly, build a little trust. Then they place a really large order, take delivery, and then significantly delay payment. It's a calculated move, basically exploiting that initial trust you built.
Oof, okay. Good to know. So how do companies keep track of all this in real time?
They rely on continuous monitoring, usually using two key reports. First, the accounts receivable age analysis.
Okay.
This shows not just the total amount outstanding from each customer, but crucially how long it's been due. It's your early warning system for spotting breaches of the credit terms.
Got it. And the second one?
The credit utilization report. This shows what proportion of each customer's credit limit they're actually using at any given time.
Okay.
So that helps determine if limits need reviewing, maybe upwards if they're a great customer, or downwards if there are concerns, or if any breaches have happened. Together, these reports give you a dynamic picture of your risk exposure.
So taken together, these reports paint a clear picture of the company's overall exposure. And larger organizations, they might take this even further.
Oh, absolutely. They often classify customers by trade, by country, trying to evaluate exposure across different markets and industries. Some even create quite sophisticated in-house credit ratings for their customer base.
Right.
And it's not just about setting terms once and forgetting them. Companies should regularly review whether their basic credit terms are still suitable. It's a fine line.
How so?
Well, you don't want to offer unnecessarily long credit periods if it doesn't actually benefit you, right? It just ties up your cash.
True.
But on the flip side, a company might strategically decide that extending its credit terms could lead to a significant increase in sales. It's that constant balancing act. Risk, cash flow, market competitiveness.
Yeah.
Always adjusting.
Makes sense. Okay, so we've assessed credit, set the terms, monitored the accounts, all that foundational work is done, but the ultimate goal is still getting that cash into the bank. What's the very first, maybe easily overlooked step in that collection journey?
It sounds almost too obvious, but it's invoicing. And critically, doing it quickly and accurately.
Why the emphasis there?
Because an invoice isn't just a bill. It's the first signal a customer gets about your debt collection efficiency. If it takes ages to arrive or it's full of errors, what does that signal?
Disorganization. Maybe they don't really care when they get paid.
Exactly. Customers might then exploit that perceived weakness, use it as an excuse to delay payment. Plus, an inaccurate invoice. That's a ready-made reason for a customer to claim a dispute and just halt all payments until it's sorted out. Speed and precision right at the start set the tone.
That's a really powerful point about setting expectations early. Okay, so the invoice is out there accurately and quickly. What are the various methods companies then use to actually chase that payment and ensure it comes in on time?
Well, there's a whole toolkit.
Okay, let's run through them. Monthly statements and chasing letters seem standard.
They are easily produced by computer systems, but our sources note their impact is often pretty limited. People get used to them, maybe ignore them, and there's still a cost to prepare and send them.
Right. Then chasing phone calls. These sound more effective.
They can have a great impact, as one source puts it, mostly due to their nuisance value, perhaps. Makes sense. Seriously, though, every business has to answer the phone. A polite but firm credit controller getting through to someone senior at the customer. That can often generate real results. It's direct, it demands a response in a way an email or letter doesn't.
Okay. What about the personal approach?
This is where a senior person in your company contacts a senior person at the customer. It's common in trades where personal relationships are really key. Think professional services like accountancy or law firms.
Leveraging that existing trust.
Exactly. Then there's the stopping supplies. Sounds like a big gun.
Definitely a tool to be used with care, according to the sources. Its power really depends. If you're the only supplier of some custom widget they desperately need, very effective. But if it's a generic product they can easily get elsewhere, you just risk losing the customer entirely. High stakes.
Yeah, you could just push them to a competitor.
Precisely. And the final options: legal action and external debt collection agencies.
The last resort, really. Both are costly, and both are almost certain to, destroy the customer relationship. You don't usually go back from there.
Right. End of the road.
And it's interesting, many larger businesses have their own in-house debt collection departments first.
Ah, okay.
They'll exhaust all those internal efforts before they'd ever dream of bringing in external agencies or lawyers. I've even heard cautionary tales, companies suffering reputational damage because they tried to make their in-house team look like an external agency, maybe with a scary-sounding name.
Trying to scare customers into paying.
Exactly. It's a very fine line between being firm on collection and damaging those crucial customer relationships long-term.
That's a tricky balance indeed. Okay, so with all this effort going into assessment and collection, companies are obviously always looking for ways to speed things up, right? To accelerate that cash flow from receivables. Two key methods jump out: early settlement discounts and invoice discounting.
Yes, let's unpack early settlement discounts first because they contain this really fascinating inherent conflict.
Okay.
So imagine a company normally offers 30 days credit, but on average, their customers are actually taking 41 days to pay. Not unusual.
Right.
To speed things up, this company thinks about offering a, let's say, 1% discount if customers pay within 10 days instead. Now, the company itself finances its working capital using an overdraft that costs them an annual 9%.
Okay, get the scenario. So from the supplier's point of view, what's the actual annual cost of offering that 1% discount? Is it just 1%?
Ah, that's the common mistake. No, it's not just 1%. Think about it. If a customer takes that 1% discount on a $100 invoice, the supplier gets $99 in 10 days instead of the full $100 in 41 days. So effectively, the supplier is borrowing $99 for the 31 days between day 10 and day 41. That's 41 minus 10. And for borrowing that $99 for 31 days, they're paying $1 in interest. That's the discount they gave up.
Okay, I follow that.
Now, when you annualize that cost, paying $1 to borrow $99 for 31 days, the math works out to an effective annual cost of 12.6%.
Wow, 12.6%, not 1%. And what does that 12.6% mean when you compare it to the company's own 9% overdraft cost?
It tells us everything. Since 12.6% is higher than their 9% overdraft cost, offering this discount is actually more expensive for the supplier than just financing the weight themselves through their overdraft.
So they shouldn't offer it?
In this specific scenario, no. It would be counterproductive financially. It costs them more than waiting.
Okay, but now you said there's a conflict.
Yeah.
What about the customer's perspective?
Right, let's flip the coin. For the customer, the cost of refusing that discount is also effectively 12.6%. If they wait the full 41 days, they're implicitly borrowing that money for the extra 31 days at that high rate.
Yep.
So if that customer also has an overdraft facility, maybe at 9%, they face a choice. Refuse the discount and effectively pay 12.6% for the loan of keeping the cash longer, or accept the discount, perhaps by using their cheaper 9% overdraft to pay early.
So for the customer, taking the discount is a great deal.
Absolutely. In this case, the discount is clearly attractive to the customer. They should accept it because their alternative financing, the overdraft, is cheaper than the implicit cost of refusing the discount.
This really highlights that conflict you mentioned. What's good for one side seems bad for the other.
Exactly. It's often a zero-sum game. If a discount is genuinely attractive to the customer, it might very well be too costly for the supplier, and vice versa. It shows these aren't just arbitrary numbers, they're strategic decisions with very real, often opposing financial implications for both parties involved in the transaction.
Fascinating. That hidden cost is significant.
It really is. And if you're interested, there's a general formula to calculate this effective annual cost. You take 1 plus D divided by 100 minus D, raise that to the power 365 divided by T, where T is the number of days payment is advanced, subtract 1 and multiply by 100%. D is the discount percentage. It's a powerful little tool for analysis.
Good to know. Okay, that's a deep dive into discounts. Now, what about the other method you mentioned? Invoice discounting. What's that all about?
Invoice discounting is essentially a way for a company to borrow cash using its outstanding invoices as security.
Like a loan against receivables.
Pretty much. For
Okay.
example, a specialist finance company, a discounter, might advance, say, 75% of the value of the outstanding invoices immediately.
Okay.
The discounter then gets their loan back, plus interest and charges, when the end customer eventually pays the original invoice. And what's often compelling is that this can be done confidentially.
Meaning the customer doesn't know.
Exactly. The customer just pays their invoices normal, completely unaware that their supplier has borrowed against it. As long as the payment comes through, they need never know.
How does this compare to something like factoring?
Good question. It shares similarities with factoring, specifically the finance provision aspect. And yes, many factoring companies also offer invoice discounting. But there are key differences.
Such as how?
With invoice discounting, crucially, the company continues to run its own sales ledger. They keep control of collections and customer relationships. Factoring often involves the factor taking over the ledger and collections. Also, factoring is typically an ongoing arrangement covering all receivables, whereas invoice discounting is often more of a one-off deal used to cover specific, maybe temporary cash shortages.
Okay, so more targeted.
Yeah.
And who finds this particularly useful? Any specific situations?
It can be a real lifeline, especially for small and medium-sized enterprises, SMEs, particularly those that win a large contract.
Why them specifically?
Well, landing a big contract is fantastic news, right? But ironically, it can cause huge cash flow problems for an SME.
Oh.
Because these contracts often involve really substantial sums for the SME's size. And while the large customers are usually reliable payers in the end, they frequently pay after a significant delay, maybe 60, 90 days or even longer. This ties up a massive amount of the SME's working capital.
So they have the costs of fulfilling the contract way before the cash comes in.
Precisely. Invoice discounting helps bridge that gap. It unlocks the cash tied up in those large, slow-paying invoices, allowing the SME to manage its cash flow, take on bigger projects, and grow without being strangled by payment delays from otherwise good customers.
That makes a lot of sense. A vital tool for growth then.
Yeah.
So, wow, we've really journeyed through the critical world of accounts receivable management today. We started right at the beginning with that vital first step of assessing creditworthiness and setting clear terms, then explored all the various practical, sometimes nuanced methods of actually collecting the cash.
Right, from letters to phone calls to more drastic steps.
Exactly. Right down to these quite strategic ways companies can speed up their cash flow using discounts or discounting. It's definitely a complex, but absolutely essential dance for any business.
It really is. And if we connect all these threads, look at the bigger picture, it all kind of boils down to one fundamental principle, doesn't it?
Which is?
That the costs involved in managing accounts receivable, the admin, the chasing, the potential bad debts, the cost of finance, like those discounts, all those costs must always be kept below the benefit the company receives from granting credit to customers in the first place, which is usually increased sales.
A constant optimization problem.
Exactly. A delicate balancing act that directly hits a company's financial health. Get it wrong, and it can be incredibly damaging.
Absolutely. And thinking about that delicate balance, that need to offer credit to win sales versus the need to efficiently collect the cash. What is that hidden tension we explored, where an early payment discount might be a clear win for the customer, but a loss for the supplier? What does that tell us about the foundational, often unseen negotiations and strategic choices that are just constantly happening between businesses, big and small?
That's a great question to ponder.
Yeah, just something to mull on. Think about how these principles apply everywhere, really, from a giant corporation down to your local coffee shop, maybe extending a tab. Understanding these dynamics, these sort of hidden financial levers, it can truly give you a real edge in understanding how business actually works.